Hey guys, it's Josh, and today I want to talk to you a little bit about non-owner occupied financing or investment property financing. Now I'm talking to you today in 1 to 4 family or 1 to 4 unit properties, not commercial apartment buildings. But I want to tell you a little bit about what's going on and what's available with investment properties. As you know, we used to be able to get up to 100% financing for these investment properties, and nowadays we're down to a maximum financing on 1 to 2 unit properties of 80% loan to value. So that's pretty much the max for investment properties. If you want to get to a 4 unit property, you actually have to go to a 25% down payment. That's 25% of the purchase price. And there are some great rates available. I mean, the rates that I'm seeing today for investment properties are unlike I've ever seen in the past. We're talking about 4.6, 4.7, 4.8% on 30-year fixed. So without a doubt, if you can find incredible buys out there and put high 4% 30-year fixed financing, you're going to have an investment vehicle that's going to cash flow forever. I own a lot of investment properties myself. Myself and my mom and my wife have a portfolio of just over 90 properties here in the Salt Lake Valley. So I've got a tremendous amount of experience in not only financing investment properties, but being able to do an analysis that will tell you if they were going to have good cash flow and if this thing's actually going to be a good investment for you. So I can help you a little bit on that end. Some of the creative ways that we've come up with for down payments include equity lines. Often people will take out equity lines on their owner-occupied homes or their second homes, and I'll film another YouTube video about equity line products that are out there. You can also take money from time to time from retirement accounts. So there are some creative ways to come up with those financing, but as of today's recording, which is, let's see, we're August here, 2010, you're going to need at least 20 to 25% down on those properties. Now, in terms of qualifying, what many people don't know is that they can actually use the rental income from the property that you're going to be purchasing to help offset the mortgage liability. So many people think, well, I'm not going to show enough income to qualify for my home and the investment property home. You actually don't have to do that. The appraiser will do what's called an operating income and comparable rental schedule, and they will use that income off of the property you're going to be purchasing to offset the mortgage liability. Typically they use 75% of what they anticipate the rents to be. So if you're buying a $160,000 property and our mortgage payment is $1,000 and the rent that the appraiser figures the property is going to fetch is $1,000 a month, then they'll use typically 75% of that, or $750, to offset your $1,000 a month monthly mortgage payment. So that's a great piece of information for you to know. You don't have to cover the full $1,000 in your debt to income ratio, maybe just the spread there, maybe about $250. So if you need more information on investment property financing, or if you have some investment properties that you might want to refinance, don't hesitate to reach out to me. Love to compete for your business when the time is right. Take care.